Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio value, how it's been performing by the metrics. Of course, we're going to go over our buying power, the individual stocks and how they are performing. We're going to look at deals within and outside of the portfolio. We're going to take a look at the watch list. And I did add another tab called Dividend Ideas, which we will jump into that a little bit as well in the video. So, jumping in today, we are down about $200, down about 0.4% today. Still sitting at $50,000. So happy with that overall number. But guys, keep in mind, I am more about the passive income generating, not about the total value of the portfolio. But I do love to see that we're still sitting at 50K. That 1 week mark, we are down $1,800, down about 4% for the past week. That 1 month mark, we are down nearly $2,600 at a 5% loss for the past month. Then we're only up $56 for the past 3 months. Year to date, we are up around $200, about 0.4%. Then that 1 year mark, we are down $500, down about 1% for the past year. And then all time, we are at $14,670.06 with a total return of 41.5% all time. So guys, I know I've said this in the videos. Of course, it is important though to highlight that in the short term, the market is a voting machine. People are emotional. You can tell that. Do you really think the overall value of some of these companies has dropped that much? Do you think Coca-Cola is going out of business? I don't think so. Do you think people are still smoking? Less, but yes, they still are. Do you think Apple is going under? No. A lot of these companies are emotionally being priced. So that leads to great deals. Guys, it would be great if every company was sitting at an AVI return. But I don't want that to happen. I would rather have my stocks go down because when it comes to dividends, the price and yield are inversely correlated. So the lower that the stock price goes, the more I make in dividends for having to put in less money per share. So I want my dividend companies to go down because I get paid more. Now, the buying power is going to go up at the end of the month. I'm going to let that 106 sit. And once that Altria and Realty Income dividend come into the portfolio, I will be reallocating that dividend income and I will be capitalizing on some of these deals that I see within the portfolio. Given that the deals stay the same, of course, anything can happen. But I'm really hoping, in time, I want Apple and Coca-Cola to keep dropping because I want to buy those companies. Now, jumping right in, we've got Realty Income sitting at around $50, $51 per share. 170 shares, $8,700 worth of market value. Average cost is right around $65 per share. 18% of the portfolio is in Realty Income. Today we're down $63. Total we're down $2,200. We have a total loss here of around 21% on Realty Income, but the dividend is still being paid at $43.69. So guys, this is, of course, a prime example of why I want these companies to go down because I'm paying nearly $10 less per share for this company. More than that. So it's down more than $10 a share from my average cost. So I can buy Realty Income at an even higher yield and lower my cost basis, and not only lower it, but I can boost up my overall dividend yield. So I get paid more per share when I buy lower, which is something that I'm always looking to do. And I actually make more money over time due to stock price appreciation and a higher dividend yield compounding at a faster rate because I get paid more for less money. So I will be allocating some of that money to Realty Income, maybe all of it, depending on where that company sits when I get that dividend payment. Then we've got Coca-Cola sitting at $58.22. I have 15 shares, $870 of market value. Average cost is right around $61 per share, around 2% of the portfolios in Coca-Cola. Today we're down $1.18. Total we're down $35. So Coca-Cola is also a nice place to be putting some cash, down around 4%. So I could buy some more Coca-Cola. Realty Income is obviously a better position to be adding money because it's down lower, but I do want Coca-Cola to be one of my foundational stocks and be one of the higher the bigger positions in the portfolio, be a higher tier than Realty Income. So I mean, price-wise, I got to go with Realty Income, but quality, I want more Coca-Cola. So that's where I'm kind of tied, I'm kind of tied up here is I like Coca-Cola more than Realty Income, but dollar per dividend, I think it's better to put it into Realty Income at this point. Then, of course, we got Altria, which is another good deal, sitting at $40.90. So we have 320 shares, $13,000 worth of market value. Average cost is $47.27. 26% of the portfolio is in Altria. Today we're down $48, but total we're down over $2,000 with a near 14% loss on Altria, with a dividend coming in on the 30th of $313.60. Guys, I could get like 8 shares of Altria if I just reinvested those dividends. But I think right now, given how much further Realty Income is down than Altria, and I think Realty Income overall is a higher quality business, I want to put more money into Realty Income. But I do like the inflow of cash that Altria does give the portfolio. Then we've got Apple. Now, Apple's down big today, sort of big, down almost 2%. But we only have 1 share. Of course, at $173.46, that's going to be our market value since we only have that 1 share. Average cost is sitting at about $133. 0.35% of the portfolio is in Apple. Today we're down $3. Total we're at $40, almost $41 with a 30% return on Apple. So even though it's down right now, I want it to fall further before I put more cash in. I want to be at net zero. I don't want to have any gain on this when I put more money into it. So I want to be buying Apple at around 140 is my max price. So I wanted to drop at least $33 per share, which would pretty much wipe out my total return there. So I do want Apple to be the biggest position in the portfolio. I just need to be patient and be smart about when I allocate that capital. So not worried about it. I'll be jumping for joy when Apple drops like that far anyway. Then we got AbbVie sitting at $162.44. We've got 95 shares, $15K worth of market value. Average cost is $95.20. About 31% of the portfolio, so a third of my investment dollars, is in AbbVie stock. Today we're up $9. Total we're up $6,300 with a 70% rate of return with AbbVie. Guys, I water my flowers and cut my weeds. I do not want to sell my winners and keep my losers. I want to let my winners keep growing. So even though I'm not going to add any cash to this position simply because it's too high above my average cost, I would really like AbbVie to drop because I want to add more of this quality business. I just don't want to add it at these prices. So a lot of investors, though, do sell the companies that are doing really well. When they see a 60% return, they're like, okay, I got to cash out. What if it drops? And they freak out about it. I'm not like that. I don't worry about it. I'm going to let the dividend keep rolling in and keep reinvesting into positions that make sense. And eventually, AbbVie, I think given time, will drop back down to a price that's reasonable for me. But some people are buying AbbVie at $162, and that makes sense if they're initiating a position. But for me, I've held it for a few years now, and I want to buy it near that $100 mark, or that $97 to $100 mark. So I'm not going to be paying, I don't want to pay a $70 premium for a company I bought at $100 per share. So I love the company. I want to add to it. I want to own more of it, but just not at these prices. And then finally, we've got T. Rowe Price sitting at $113.79. We've got 100 shares. I love that share count. Market value is at $11,000. Average cost is around $110, so we're nearly break even here. 23% of the portfolio is in T. Rowe Price. Today we're down $140. Total, we are up $400 with a near 4% return. So guys, I have a long-term view on T. Rowe Price. If you look back on the chart, not even two, 3 years ago, it was sitting at $200 per share. It's at $113. So even at these prices, even though my average cost will go up a little bit, I still think it's a great deal. It's a phenomenally run company. I understand the business model. I think they allocate capital very well overall in the business, and I think it's been mispriced, and I'm hoping to take advantage of that even more once the price drops down below my average cost. So I want to own this for the foreseeable future, unless something changes, unless they have a management change, a dividend cut, they maybe buy a business that doesn't make sense within their field, something like that. But overall, I don't see any issues with T. Rowe Price, and I'm just going to let that dividend keep compounding. So then we've got Alphabet or Google. at 157 today. One share, of course, our market value is going to reflect the price at 157.01. We have 155.47 for our average cost. 0.32% of the portfolio is in Google. That's going to go up. Today we're down $2. Total we're up $1.50 with a 1% rate of return overall. So I love Apple, guys. It's going to be one of the foundational stocks. In order, I do want it to go Apple, Visa, Coca-Cola, Google, and Berkshire, or flip Berkshire and Google. The fourth and fifth spot, I feel like they can be interchangeable because I like both businesses a lot. But I do want this to be a top 5 foundational stock, so it does need more capital allocated to it. And this price is close enough that I'd probably just purchase more. But given the fact that I don't have the dividend cash flow right now, I'm not going to be purchasing stock at these prices. But I am going to get my tax return. I'm going to knock out a lot of my credit card debt, and within the next few months I should be able to at least before the end of the year, I should be able to allocate some fresh cash into the portfolio that is not dividends. Then of course we've got our watch list that we can go over real quick. We got Visa sitting at 271. So 52-week high is 290 and 216. I wanted it 250-ish, so I wanted down like 20 more bucks per share, but it is nice to see it drop that much. I'm not as picky with Visa because I just want to own the stock. I know for a while I said I wanted to use Altria money to buy it, and I still could do that. It's just Realty Income is at such a good value right now that I feel like it would be a dumb decision to buy Visa over it, simply because I feel like I get more for my money with Realty Income when it comes to stock price appreciation. And that monthly dividend as well will be going up. But Visa is going to be a powerhouse of a stock for the portfolio. Once I get my shit together and get my debt paid off, I will be heavily putting money into Visa when it makes sense for my average cost. Then of course we've got Berkshire. I've talked about Berkshire a lot. I've even done a solo video on it, so I won't go super into depth. But long story short, I want the financial piece of Berkshire. I want the insurance business. That's the main reason why I'm buying Berkshire Hathaway, is that the float that they accumulate and reinvest. I think that even if Munger and Warren are not there, I believe that current management have been in the fold of Berkshire for long enough that the integrity of the business and the integrity of the business model will not be affected by new leadership. So I do think that the stock's going to drop massively when Buffett does leave us. So I want this to be a pillar in the portfolio as well. And I do think that over time it will become one of the bigger positions. I just need to be patient about when I buy it. It's just like Apple, guys. I think it has a huge moat. It has a great arm in insurance. They are very smart about what businesses they buy. And I think, honestly, with the new regime coming in the next, decade, I think that we could see some really big shifts, not necessarily in like the culture, but I think that we'll see more of Ted and Todd, the lieutenants, getting a little bit more cash influx, and the changes in overall investment philosophy. So one of the things that Buffett and Munger have talked about is they don't understand technology. Well, there's a good chance that the people who are taking over for them, they have bought Amazon stock. They have bought Snowflake. They've bought different companies that Buffett wouldn't understand, but his lieutenants and possibly his successors could understand a little bit more thoroughly. So there is a possibility there that they could get a little bit more tech heavy. I know they have Apple, but he bought that as more of a consumer device versus a technology company. But I do think overall Berkshire will be one of the biggest and best performers for my portfolio. And then we've got Facebook, guys. I want to buy this around $200 a share, so I'm going to be waiting not 200, but like $250 to $300 a share. Sorry. So I'm going to be waiting a little while, but I'm okay with that. I love Facebook. I use it all the time. I use Instagram. My girlfriend and I talk on Messenger all the time. My friends and I have group chats on Messenger, so it'd be dumb not to own a piece of the company I use every day. I mean, this is kind of in the same philosophy as something like a Coca-Cola or something like something like Apple. I use my AirPods when I mow the lawn and when I listen to music all the time. I even have them in my car. So I use it every day. Visa, when I buy anything, I swipe a Visa card. They get a portion of that transaction, and I'm paying Visa every time I use their card for their payment network. So it's same idea here, guys. I use social media every day. Honestly, I should have bought this stock when I was like 15, 16 because I've used it that long. I'm 28 now, so I could have owned Facebook for 10 years and had crazy returns. So I've just been dumb and haven't bought the stock. So this, honestly, you could say the same thing for Berkshire or for Visa. I just need to put money into the portfolio, put free cash into the portfolio, and buy these stocks and cost on average. So, guys, with that, I do want to go over real quick. I do have some dividend ideas like Pepsi, Costco, Starbucks, Globe Life, and Aflac. So I've owned Pepsi before. I enjoy the company. I use the products. I'm drinking a Baja Blast right now. Costco is more of a RIP to Charlie, but I do like the business. They have crazy amounts of cash flow and cash on hand. Starbucks, I see it everywhere. I mean, my girlfriend and I go there sometimes. It's a stock that is in my daily life, or at least weekly life. Globe Life was just one that I saw that went down a lot, so I need to do more research on that one. But Aflac, I've owned nearly 200 shares in the past, and I feel like that's been one of my biggest investment mistakes, is selling Aflac. So I mean, I don't plan on adding anything to the portfolio. These are just ones that I am looking at, and if the price drops significantly, like if Aflac goes back to my average cost per share, I would like to reinstate that overall position, but we'll see. With that being said, guys, I will see you tomorrow with another Robinhood portfolio update. Remember to hit the subscribe button, the like button, and I'll see you guys tomorrow. Take care.